Good morning, good afternoon, good evening, and welcome, wherever you are on this wonderful planet to the Bull versus Bear Trade Day webinar on Wednesday, the 30th of March, 2022 with Steve Miley here on the call. Welcome, everyone. We'll go through our usual, normal, regular run through in here today with me on the call. Thank you for James for covering the webinar yesterday. So we're going to take a look at what's going on in the markets with respect to the calendar. Okay, so we'll kick off with the calendar. I'm going to come back to this chart. This is the bond chart, but we'll come back to the bond chart. I'm going to kick off in here with the calendar, what we've had, what we've got coming up. We'll take a look at some articles from the major news wires. The reason I started there on the bond market was because there's a big focus on the yield curve. I know James spoke about that yesterday. We've been speaking about that on the webinar for the last 2 to 3 weeks, right? Focusing in on the yield curve, potential recessionary pressures coming from the or indicators coming from the yield curve. We'll talk a bit more about that now. I'm hoping to get an article out, a blog post out on that in the next, maybe by the end of the week. It could be beginning of next week. So a bit of an explainer article blog on the yield curve and the current environment on that. So we'll take a look at that, but we're in a little bit of depth in here today. I'm also going to take a look at the articles from major news wires in here, what's driving markets right here, right now, today. Anything new? Not too much new, to be quite frank. And then we'll take a look at the charts, right? So, and I've got a bit of a deadline here today, so we're going to be certainly wrapping up in about 20 minutes time, so it's not going to be too long a webinar. So first of all, let's take a focus on what we've had, what we've got coming up. Now, in here, the important piece of data in here for today is we've not had it yet. Well, from the US, obviously, for you guys from the US, and most of you are, we've got the GDP data. Now, GDP, even that's a massive piece of data, gross domestic product, everything we make in an economy, it's very, very lagging data. I mean, this is GDP quarter on quarter for Q4 of last year. A lot has happened since then. The Fed have raised hikes, the Fed have become uber hawkish, and we've had the biggest conflict break out in Europe since World War II. So quarter on quarter GDP in here, do we really care? Probably no. So GDP, very backward looking data. It's not going to be that important to us right here, right now. Ahead of that, we do have the ADP, non-farm employment change. Remember, this is a precursor to the employment number, the actual official employment number. ADP do their guesstimate, their survey of a guesstimate of what they think the number is going to be on Friday. Okay, this used to move, back in the day when I, well, not when I first started, because when I first started in the markets over 30 years ago, this data wasn't around. However, when it was introduced, I don't know, maybe something like 15, 20 years ago, it was really much watched, and it really did move markets. The last 5-10 years or so, I guess 5 years or so, hasn't moved markets nearly as much. Okay, but nevertheless, we're going to keep an eye on it anyway. And particularly, even the employment report is not that important to us right here, right now. Why is that? Well, it's because we've got a situation where we're at very high employment, very low unemployment, so this is not really impacting markets right now. What's impacting markets right now? The inflation rates, right? And obviously what's going on in Ukraine and between Ukraine and Russia. But what's impacting markets from a macroeconomic standpoint is the high inflationary pressures, which don't really feed into what we're seeing on the employment side at the moment. So this is not really as significant. I think what we really want to, and I know you guys are trading US markets, most of you in here, but is this German CPI number. Now, in 5 things to start your day, they've already mentioned in here, if we take a look at where are we, inflation, and they're talking about it in here. I think, look, European inflation came in very hot this morning. Italian and regional German readings. Okay, so the Italian data is not on the calendar. In this calendar I've got in here, we've already got the filters applied, so it hasn't got the Italian data in here. But if I just actually do click in, hopefully I can just click in just for today, the Italian data. Where are we? I for Italy. Where's Italy? Oh, there it is. Okay. So I'm going to apply that and see if we can get the Italian data in for today in here. So here's the industrial sales data. That is okay. Here's the Italian CPI. Okay, PPI data in here. Okay, so it's actually not showing us what the forecast was. But my understanding is this is running hot. Okay, PPI data year on year 32.8. That's massive, right? So that's this is running hot. But also we had the regional, and the regional German numbers are not on here. Okay, now the regional, so German releases its CPI data by region, and then afterwards we get the overall data, and you can see in here here's the overall data. We've got that coming in 26 minutes time. We're talking, what time are we there? In the US, we're talking at 8 o'clock, right? 0800 in US time in here. So we're going to be certainly keeping an eye on that, because obviously global inflation is a problem. And so the regional data has come in and it's higher than expected. And that's had an impact on markets in Europe already this morning. Okay, so we're certainly going to be keeping an eye on that. And then you've got the ADP number. We also have got oil data in here a little bit later today as well. So keeping an eye on those. Let's go and take a look at the 5 things to start your day in here. So some skepticism. So we had some kind of good news yesterday. Well, on the face of it, good news. Ukraine seemed to offer something more to Russia, and Russia promised to scale back military operations in Ukraine around Kyiv. Okay, and it looks like they're starting to. Their goals are now to take the eastern provinces, the 2 eastern provinces, which we've spoken about, okay? And then also this land corridor from the Russian border to the Crimean Peninsula, okay, which Russia annexed previously back in 2014. So, it's seen progress. Markets, equity markets like that, riskier assets like that yesterday. Bonds actually rebounded, higher prices, lower yields, seeing more of a risk-on environment in there. So, we've certainly seen a little bit of a more of a positive spin from the talks in here, but is it spin? And there's a very much a wait and see. Now, on that note, we have had some Forex Live have put up just recently in here, not too long ago. This popped up about an hour ago. Russia says they will provide update on peace talks later in the day. But has not noticed anything really promising or a breakthrough. There is a long work ahead. Okay, so we may get something later today on the peace talk. So we'll be watching out for that certainly. Going back in here now, the big thing in here that there was. Let's just cover some of the other stuff first. Crypto heist in here. The Axie Infinity online game, big crypto heist. I think it was like $500 million, $600 million. There you go. Yeah, from a blockchain network. So it took them a week to discover it as well, which is really worrying. Stock slightly lower. We'll take a quick look at those. So if you take a look in here, you see European stock indices down in here, not hugely down. Some of the bourses in here only 0.33%. The French CAC index is down just under 1%. The DAX in there 1.2. FTSE is actually hanging in unchanged in here. So markets in here kind of slightly lower in Europe on the back of that high inflation news from Germany, and also on the back of maybe not quite. Maybe we got a little bit too ahead of ourselves on the positive news or the perceived positive news from Russia, Ukraine yesterday. Okay, so we're certainly seeing a dip there on European stock indices. And if we look at the futures in here, having had strong gains again yesterday, S&P was up over 1%, down nearly 1%, NASDAQ over 1%. You see today, this morning, but we're not massively down. It's only a dip lower, couple of tenths, 0.25% in here on the Dow and S&P Mini, less than 0.5% down on the Nasdaq. So not a disaster on the downside at all in any shape or form. So just a slight dip in here this morning, and then and then coming up, they're talking about the German national inflation data. Okay, so that's 8 a.m. New York. Okay, so or Eastern time. So we're certainly going to be keeping an eye on that. And then straight after that, we've got the ADP employment. And not too worried, I think, about the GDP data in here later on today. So we're watching all those things. Now, the yield curve, I know James spoke about it yesterday. I've been talking about it for the last 2-3 weeks. We've had different parts of the curve invert. Typically the longer end will invert quicker. So we saw the 5s, 30s invert last week. Okay, we saw an inversion there. Yesterday, the 2s, 10s. Now the 2s, 10s is probably the most watched, has inverted. Okay, so with 2s, 10s, and remember that 2s, 10s went in the past. Post-war era, post-World War II era, certainly when the yield curve is inverted on most, not all occasions, on most occasions when that has happened, we've seen a recession 1 to 2 years later, with I think an average of about 15 to 18 months later. Okay, so you'd be potentially looking at a recession going into next year, and hence, that's why we're seeing interest rate cuts being priced in for 2023, and hikes for 2022, and then some interest rate cuts potentially out into 2023. And then we're going to just have a quick look at a couple of articles, run through it. There's a load of articles in here at the moment all about this. So stock snippets, bond market suggests pain for the US economy. What is that pain? The economic pain being singles is the 2s, 10s curve being inverted. Okay, first time since September 2019. Remember September 2019 in here. Okay, so this is pre COVID, right? So you could almost argue that it was a precursor to COVID. So it was the market was already flagging in September 2019. Bond markets flagged a potential recession. Now, obviously, we got that come through because of COVID. However, the market was already flagging a potential recession even pre-COVID. Okay, so we've seen the inversion there. Okay, an inverted Treasury curve has in recent decades been followed by a recession within 2 years, including the 2020 downturn caused by the COVID-19 pandemic. Okay? It's not been always. There have been a few occasions where it's gone just inverted and the market hasn't seen a recession within a couple of years. Okay, so let's have another few things. Inversion of key US yield curve slice. Curve slice is a recession alarm. Again, same kind of thing in here. This time coming, they're both out of Reuters actually, coming out of Reuters in here. Don't know if they've got any more depth analysis. And it was a brief moment. It's intraday. It didn't close through zero. Okay, so it basically just means the 2s 10s is just the difference between the 2-year and the 10-year. You know, so usually 10-year longer dated securities have got a higher interest rate. Why is that? Because you want a bigger premium to lock up your money for longer, and because there's more risk of inflation rising going forward than it is in the short term, right? So, and so when it inverts, that's a signal of potential recession in here. And so, yeah, it was an intraday. Look, I mean, and look at, briefly as well. I mean, I think we're talking probably for minutes. Okay, the spread dropped below zero for a time on Tuesday, yeah, and this is like what. I don't know. So, you know, these are half-hour segments. So I think this is maybe a 1-minute chart. So it went inverted for literally a few minutes. Okay. So, and then, it came all the way back up here to, like 4 or 5 basis. Well, these are basis points. Yeah. 0.04, 0.01, 0.02, 0.03, 0.04. So it came from like 5 basis points, 0.05, down to just inverted. I mean, literally for a second, probably didn't even get to -1 point. So it's less than a whole basis point, less than a hundredth of 1%. Okay, and then we're back up into here towards 4 or 5%. Okay, so yeah, so it was hardly a big inversion of the yield curve. Again, look, US Treasury yield curve flashes red to investors. So and then what the other thing I wanted to go back in here. So this is winding back. So this article back from the 21st of March. Remember when Powell spoke? We said we were looking at the wrong part of the curve. We should be looking at the 2s. He said the 3-month to 18-month forward. Okay, the 3-month to 18-month forward yield curve. Okay, so the 5s 30s we know were already inverted. 2s 10s yesterday. The 3-month forward though is still very steep. Yeah, it's got it's nowhere near inverting. Back here when this article, so it's like over 2%, right? So it's way off inverting. Okay, so from as far as he's concerned, that's not an issue. However, this article came out a little while after that, actually, the last couple of days. Fed's Powell is trusting the wrong yield curve, Citi says. So Citi in here, Citigroup, published this article and they're talking about the fact that he's looking at the wrong part of the yield curve, and their analysis, okay, basically says that, but it's not exactly doomsday in here. This is from a couple of days. Citigroup calculates the risk of a US recession in the next 12 months has risen to 20%, up from 9% in February. So yeah, it's higher, but it's still only a very outside chance at 20%. But that's in the next 12 months. It doesn't say beyond 12 months. Okay, so but he's saying that basically that they're saying in here, Citigroup, that we're watching that their analysis says that he's looking at the wrong part of the curve. They're not necessarily saying that the 2s 10s or the 5s 30s is the correct point, but they are saying that, where is it actually? Sorry, steep curve. So he's ignoring the forward curves that he's deeply inverted. Okay, so signaling recession risk. So yeah, a different take on it from Citi there, even looking at the shorter end of the yield curve. And then a little explainer article in here. I'm not going to go into much depth on this. If you want to find it, go to Reuters explainer, looking at yield curves, why an inverted yield curve may not be all bad for US banks. So just if you're looking at the individual sectors, financial sector likes a steep yield curve. Why? A steeper yield curve, banks can borrow in the short term cheap and lend at the longer at higher levels, higher interest rates. Okay, so it's the basic banking model. This article goes to explain why an inverted yield curve you would think would be bad for banks, but it goes on to explain why it's not necessarily that bad for banks. Don't really have time to get into that. If you're interested, go take a look, go find that article in here on that explainer. And then just little recaps in here from Bloomberg. Stock full, oil rises. So oil's pushed back up again. Oil's been dropped for the last 2-3 days in here. Went back sub $100 in here at one point, and certainly indicating or taking some of the pressure off what we're seeing in here. But nevertheless, oil has rebounded. So again, the oil climbs after 2-day drop as investors assess Ukraine talks. Okay, US says Kyiv still at risk despite Russia offer to pull back. So despite that, so WTI rising back up to $107 and $107, having dropped 8% in the prior 2 days. And then just a little touch on this. So the Bank of Japan have been in buying bonds again, trying to drive yields lower. Okay, trying to keep interest rates in the long term lower. And a nod as ever to Seattle future rate hike for the next meeting in here on 4th of May. We're looking at nailed on for 25 basis points, and then looking for a chance now. This has been hovering now for a while, between 60 and 70% chance now. So more of a chance of the next rate hike. The market is pricing at being 0.5%. Right, a whirlwind tour around the markets, okay, because I do have a time limit today. Here's the bond market, first of all. Just did want to have a quick focus on that because there are all eyes on the yield curve. So bonds have obviously been in a lower price. This is the future, okay, ZNM, M for ZNM2, M for June contract 22, ZN is the code. So here on Tradeovate, so we've been seen a big sell-off, lower prices, higher yields. Okay, lower prices, higher yields. But we have had a respite from that the last couple of days. A rebound back 2 days ago on Monday. A further, much stronger rebound yesterday, and even higher this morning. But look, already a failure back lower. So we've gone from pushing back to higher prices, lower yields. Now reverting back to lower prices, higher yields. We're kind of unchanged on the day, but this looks like a failure candlestick already. Now, obviously, the market's not even open yet. The futures market not even open yet. Nevertheless, this does bode for potentially a pushback down into lower price, higher yield territory. That would then be obviously a negative for stocks. The rebound in here has helped stocks higher over the last couple of days. Let's go and take a look at those stock indices in here. Here's the S&P 500. So surging. Another really strong. We flagged these as targets yesterday. We broke through those targets yesterday, and then now the market, remember this is the all-time high. It's on track for the all-time high. Let me just go in here and just see if I can just put in here. Then also the 78.6% retracement. So my keyboard comes alive. 1 second. Okay, so you can see here we're heading towards a 78.6. That's the final retracement. You've also got some congestion around here. So a potential target today around 46.50. Not maybe looking as big a move as we have we've had the last few days. Maybe a bit of a tempered move. We've had a little bit of a dip. We've also seen that dip and a rebound. And we'll see that if we go in the 30-minute chart. Now, despite the dip, very shallow dip, already swinging back higher. You'd argue in here, if we zoom in on that, well, one thing in here. So this is just, you've got obviously the longer term, the whole rally. Let me get rid of all these drawing tools. So the long-term rally, these trend lines in here have kind of been, as the market is explosion higher, and then it's kind of rounded off slightly. So any trend line that comes up off the low now is redundant. And what is not useful, just a little bit of teaching. So, if you did draw a trend line up from the low, any trend line from here is now redundant, right? Because you had that explosive initial rebound. But then what you really shouldn't do is start drawing the trend line all the way up here, right? That's not particularly useful. What you want to do is now look at where the next kind of trend started after this explosion higher. So getting rid of this. So I would argue it's somewhere in here, right? So you got this initial explosion higher, and then the trend really starts again through here. This gradual trend after the initial base was put in. Remember, we did have a basing pattern down here. Okay, after this initial base was put in, you get more of a gradual move coming from here. So I would argue that the actual trend probably starts around here, right? This next trend. And if we go in and extend that and say the default and apply. Okay, and then so that one's not really that useful to us right now, but then you've got other trend lines obviously we can put in. So maybe coming from this next point through here. And then you've got the super accelerated one in here from the last few days. That comes up. This is this now reacceleration higher through here, which we've had broke that trend line, yeah. But then if we just zoom in, I'm going to just come there across and zoom in to this latest up leg, which we drew that one off of there. So let me go grab that. Okay. So now we've broken this trend line. But if you just think of this up move here, and I put a fib on here, I'm going to put a Fibonacci retracement from the top. Actually, let's do it the other way around on Tradeovate. Don't know why, it's a silly system, but nevertheless, on this latest up leg, you can see the market's held above the first retracement. The 23.6 was the most minor retracement of the up leg from the where is that? The 28th. So that's from the beginning of the week. This week's up leg. So just this week's up leg, we've held above the 23.6. And then I like to look for clusters of support. So what I'm also going to do in here is we're going to do just the up leg. So there's Monday's rally sideways overnight in here, and there's Tuesday's rally. So where does the Tuesday's rally begin? Well, you could argue it comes from these lows here. So I'm going to take it from these lows here. So in here, you have to do it off the top through to the lows here. And then you can see in here, even on this one in here, we've actually held just the up leg from yesterday. You can see here, look, there's the line there. That line there is the 38.2% retracement, and we've held in the 38.2. So we're holding basically the 38.2 of just yesterday's move and the 23.6 of this week's move, just the Monday through Tuesday move, okay? So we're holding above these important support levels and then swinging higher already. And if you zoomed in even more in here now to like a 15-minute, and then we'd have the counter trend line to the trend line that comes down, and clearly we've broken that, right? So you've got this counter trend line here of the little correction that we've seen in here this morning, and already broken up through that, okay? And then also above this swing peak in here. So if there's a little counter trend down, now the market has not only done a reversal of the trend line, it's done the Dow theory reversal. Remember Dow theory, lower low, lower high, lower low, lower high, lower low, lower high, lower low, higher high. So we've got Dow theory reversal. Now the price action tells me we can easily push back up to these peaks and then beyond. And then we've already looked at the bigger picture. If I go back to the, where are we? Oh, actually, I've just realized I flipped over in here to the NASDAQ. I flipped over to the NASDAQ. Here's the S&P. But so for the S&P, I think we could easily hit there. Sorry, I was doing the analysis there on the NASDAQ. But it's going to be the same analysis, guys. Right? I'm not going to go through all the analysis again. I just don't have time. But yeah, so you can do the same analysis for yourself in here. And, you know, I think you'll find that you're going to see the same kind of retracements have been respected here on the S&P 500 on this latest move in here, on this little dip lower. You know, if you put the just on this today's the 2-day up move, and then also on the 1-day up move, you'll see the same supports are going to be respected. Okay, right. So still bullish for me. I think you buy that dip, and we've already had the dip, and now we've got the rebound coming through. Let's take a look at gold and oil. So in here, here's gold on the 30-minute chart. I think the base is in gold now, and then I think the real risk up to these peaks up here. Now, so you know, if we take out these peaks in here, then we can easily push higher. If it doesn't get above this peak here, I mean, we felt at that, you know, this morning. If it doesn't get above that peak there is now. I'm still got the I'm sitting on the June contract here, but you can I think trade April or June at the moment. They're kind of equally liquid. But the high in here, I'm struggling to see that. 1934.4. Whilst below 1934.4, I think you can have tentative shorts. But if we break there, I think you've got to reverse to a long. Okay, let's take a look at the 30-minute on the oil chart. So there's the rebound in here, you know, big sell-off in here the last couple of days in here, and the acceleration lower. Market has managed a rebound. Again, I think, you know, potentially, it's a tricky one. Is that a base going in? It's not a base until we get above that high there. So oil needs to clear 107.84. And you can see 1, 2, 3 times now it's failed at that peak at 107. Just double check that is 107.84. Excuse me, 107.84. If we can't clear 107.84, I would say through the US Open, and then there's a real risk that this trails back lower. So again, I think probably tentative short. If it clears 107.84, it goes bullish. You know, bullish obviously going to be bad for stocks. If it rolls back lower from below 107.84, positive for stocks. All right, guys. I've been a bit of a deadline, so I'm going to wrap it up there. I'm going to wish you all a great trading day. Please do stay safe. I will be back with you with another bull versus bear webinar on Thursday.